People always wonder why their trades keep going the opposite direction. You enter what looks like a perfect setup and price immediately goes against you. The truth is, it's because most traders make the market way more complicated than it actually is. If the higher time frame is bullish, you should not be trying to short every pullback. If the higher time frame is bearish, you shouldn't try to buy every bounce. Trading is very simple. Traders are the ones that overcomplicate it. So this video, I do want to go over overall bias of the market, different time frames, and how I align those to actually build my bias aside from my macro. The truth is, a lot of traders are overcomplicating this, and I think this video is so necessary for anyone just starting or people that are looking into getting into swing trading, because overall your bias with the market structure is one of the easiest things that you can look at. I've said it many times before, market structure is only around 25% of my entire strategy. Everything else falls on the macro portion of it to carry these trades. And once you guys realize how simple market structure actually is, you can build an easier bias using macro and everything becomes more seamless and stress-free. So the real problem that everyone ignores is the higher time frame, and nobody likes looking at the hourly or the daily, and this is the biggest mistake. You're reading structure from the wrong time frame. Traders will see a bearish break of structure on the 5-minute and convince themselves the entire market has reversed. Meanwhile, the daily and the hourly and the 4-hour are still bullish. Now, this would have become very clear for me in my gold trade that I'm currently in. As you can see, as I've marked out many times before, we are still very bullish in this market. Unfortunately, if I hop down to the 5-minute time frame, this is going to look a lot more bearish. And if I was to take this leg of price action right here, we can see we have a lower low, lower high, lower low, lower high, lower low. Oh my gosh, we're bearish. Gold trade isn't going to work out. But did I flip the script? Did I exit this trade because of that? No, I did not, because the overall time frame is still bullish. And as you can see, we came close to my entry, but rejected right off of it and continued to the upside. So if you're a beginner, you must follow the higher time frame bias. You can use the daily as your trend, the 4-hour for more direction, 1 hour for your setups, and the 15-minute to the 30-minute for your entry only. The lower time frames are not where trend and direction comes from. So I know a lot of people do trade counter trends, and yes, can you sometimes take counter trend trades? Of course, but only if you're extremely skilled and know what you're doing. Counter trend trading is very advanced. It requires experience, timing, precision, and a deep understanding of the market's behavior, and a little bit of anticipation if you're trading from a macro stance. If you're still learning, counter trend trading will destroy you. Beginners should trade with the trend, not against it. Now, I'm no beginner, but as you can see from my other trades, I've only been trading with the current trend. I never take counter trend trades. And as you can see with the 1, 2, 3, 4, 5 trades that I've taken live in front of you guys, I've only lost one of them. Now, I could have just gone break even on this trade when we hit a 1-to-1 and moved away so far from my entry price, but I was still pretty confident in my current macro bias that I didn't do so. Unfortunately, that didn't work out, but no problem. There was a macro catalyst that caused this to hit my SL with a lot of force. Did that shake me off my game? Not at all. The overall trend is still bullish. So what did I end up doing? I ended up waiting for more confirmations to the upside before taking another long position, which we closed $4,400 in profit on and are letting another $4,400 of this trade ride. Now, I could have taken the trade right off down here when we had this breakout to the upside, a retest of this area, but no, I waited for 3 forms of confirmation on this trade before entering. And this is why it is so nice to follow the trend as a swing trader. You're not fighting which way the market is going. You're just saying, hey, I can see the direction is moving in this direction, and I would like some more confirmation. That wasn't enough for me. I said, I want more confirmation. That wasn't enough for me. So I said, I want one more form of confirmation, which I got and yielded me $4,400 in 3 days. Now, along with trading against your market structure, your next killer is going to be trading against macro. This is the second big reason that traders pick the wrong direction if you ignore macro completely. So if you're taking longs on gold, even though the US dollar is strengthening, you're shorting Euro USD, even though jobs data is weak and USD is falling, you're trading candles. The market is trading an economic reality. Direction comes from the strength or weakness of the economy. Inflation trends, interest rate expectations, jobs data, market sentiment, Fed speeches. If you don't understand the macro environment, you're just guessing with candles. You're not actually trading. You can flip the script on this too and trade entirely from market structure. If I was just taking this based on, oh, we have a higher high, we're going bullish, wait for that lower low to be put in, wait for a break and retest of this higher high, and take longs, you can do that, but there's no difference between that and guessing. That is just educated gambling because I don't know what's going on behind this that is making the market do this. Now, the killer of most gains with this is entering at the wrong part of the move. Even when traders finally pick the right direction, they still lose because they enter at the wrong location. You see a big breakout candle and think, oh my God, it's going, I need to get in. No, that is the worst place that you can enter. You're buying at the top of the move or you're selling at the bottom. My rule of thumb, if you're not entering at a clean area of interest, you're already late. You need trend direction, macro alignment, an actual level of where price makes sense. If that level is not there, the trade doesn't exist at all. Don't force your entries, wait for the market to come to you. And this is why I love the break and retest model so much, because there's always some sort of catalyst that pushes the market higher before retesting that area to continue even higher. And with something like this, I'm not trying to buy as soon as this high is broken. Now you can do that, but that does get really dicey and that's not good for a trader psychology. If I bought right here with my SL, say at this low, we're already coming halfway through my SL before moving away, when all I did was wait for a higher area of interest to have a good break and retest before continuing to the upside. Now I did go really aggressive on these stops, so maybe this isn't the greatest example of this, but as you can see from my other trades, there is very, very little drawdown on all of them. Why is this? Because I choose good areas of interest to frame around my trade. Even this loser, look at this perfect entry on this. Rule of thumb, let the market come to you. A lot of beginners just enter because a candle looks big, a pattern looks clean, they're bored, or they feel like something would happen. And to me, this is not trading, that's just emotion. A real trade comes from a real level. And the part that nobody wants to hear is that if your level isn't formed, you do not have a trade. You're just trying to manufacture one. There's absolutely nothing worse than having a perfect macro bias, the market structure agreeing with you, and then not having an area of interest that you like that you can take a break and retest off of. This is when you start forcing a trade or trying to manufacture one. And that is the one thing that you can never do. If there's no area to take your entry off of, do not take the trade at all. So I did make a video of my trading checklist, but I wanted to give a quick direction checklist that I use to make sure that I'm trading in the right direction. 1, what is the higher time frame doing? Does the higher time frame agree with my trade? Number 2, does macro support this direction? If it doesn't, no trade. If it does, next step. 3, is there a major catalyst coming? If yes, wait. If no, proceed with the trade. You don't want a catalyst coming in and slamming your SL like this when you're perfectly positioned for a move to the upside. 4, am I entering from a real area of interest? If not, no trade. Number 5, am I early or late to the move? Never enter in the middle. You can be early here, you can be late here, but you got to find that perfect rhythm of entry where you like the trade from that has the highest probability of hitting the take profit level. So this is why most traders keep trading in the wrong direction. They ignore the higher time frame, they fight the macro, and they enter in the middle of a move, and they trade without real levels. Trading is very simple. Follow the higher time frame, trade with macro, wait for your levels, and stop forcing trades. If you do this, the market will suddenly stop feeling like it's hunting you. This was a quicker video just talking about a single topic that I think would help you guys a lot. If there's any other videos you want me to make of something that you're struggling with, or just would like to hear my thoughts on, please leave a comment below. I'd love to hear so. But for the meantime, we'll see you guys in the next one.